So now we're on the final part one, and in this final part, part four, we're going to be looking again at price, but now how does it move and why does it move in that way? So getting more now into analysis of the actual charts and the analysis of the actual price movements. So remember in the last part, I mentioned the word price action. So price action is the movement of those candles over time, and that's what we're going to be looking at in this part. So let's first look at the two terms bulls and bears. So I'm sure if any of you have watched any films like Wolf of Wall Street or Margin Call, any of these sort of trading films, you probably have heard of the terms bull and bear before, but if you haven't, let's have a recap of that. So this is a trend that's going upwards. You can see there's a zigzag going on, right? So the market goes up, goes down a bit, it goes up, goes down a bit, and goes up again. But notice that even though it goes down, it's going up more than it goes down. So as the market zigzags to the upside, it's creating these swings up, swings down, swings up. But overall, the direction of that is clearly going up over time. Because if you went from left to right as that time axis goes, you start at a low price and you end up at a higher price, even though you do have some downwards movement in between that. And the market always moves in this way, right, in a zigzag sort of way. The market doesn't just go in one direction forever. It goes up, it goes down, it goes sideways, always moving in this zigzaggy sort of wave type way. This is clearly a trend that's heading upwards. Therefore, what term can we apply to this chart? Well, it's a bullish trend, right? So it's a bull chart because the bulls are the buyers, the bears are the sellers. So therefore, because this chart goes upwards, it's simply a bullish trend. It's a bullish chart. So if we then look at the real example of this, we can see how you go from the bottom, you go to the right. So as the time goes from left to right, the market is going up and down, but the way it goes up, it's quicker and it's bigger than when it goes down. So essentially you have these waves of the market going up, or the swings, it swings down, swings back up again, but bigger than it did before, and then back down, and then back up again. So clearly you are making these movements, therefore you can say that this is a bullish trend because you're heading upwards, right? It's a bullish trending market. So now you can identify that sort of upwards movement, and we'll look a bit more into this and into why this happens a little bit later in this part. But that's the simple explanation there of the bullish trend. So of course, you flip that on its head. If the market goes down quicker and faster than it comes back up again, and obviously it goes down more, comes up very slightly, goes down again really strong. That's a bearish trend because it's the opposite of what we see here. And an example of that would be this. So here you can see there are candles going up, the candles going down, but the market overall is moving in a downwards fashion. So there you have downwards price movement, upwards price movement, strong down movement, slight retracement back up, and then right back down again. So the market's moving in this zigzag wavy fashion, and it's going in one direction, and that's down, and therefore it's clearly a bearish trend because the bears are in control, the sellers are overall in control. Sometimes there isn't a trend. So the market's going to be moving up and down, up and down, up and down, but you may notice that there's not really any direction going on. So sometimes it might look like a direction is starting, and then straight away, bang, it just goes straight back down again, and it goes back up and back down. So this would look something like this, right? The market goes up, it goes down, sort of like the same amount, but then goes back up again. You might think, right, this is getting ready to go higher. Then it goes right back down again, and then back up, and then back down. So it's clearly not going in a direction, right? So there is not a trend here. You're going sideways, and there's no overall trend. So there can be smaller little zigzags in between. You might think that the trend is beginning, but overall, we'll look at a real chart of this in a second. It's just obvious that it's not going in any particular direction. And the words we use for this are sort of two words for this, consolidating or ranging. So of course, like sideways, these are the more sort of technical trading terms for it, is consolidating or ranging. So it's in a range or it's in a consolidation pattern. So if we look at this chart, you can see that here, right? Because you start from the left-hand side and you have the market going up and the market goes down, goes back up, goes down, but it's not really making any directional headwind. It's not really making any directional movement. It then goes down a bit again, back up, then back down. So you do have some points that are higher and some points that are lower than others. But really, at the end of the day, the swings aren't resulting in any directional movement because it's just going sideways, right? So therefore, what can you call this? Well, you can call it a range, you can call it consolidation, a consolidation pattern, and the market is simply going sideways, so that there is no trend there. Now, it's easy as ABC, right? It's like a Michael Jackson song, I think. And ABC is how we can represent the waves or the zigzags on the chart. And it's a much easier way of looking at it, right? It makes it easy to understand. So here we have a market, and we can obviously identify which direction this is going in. We can't yet. We need another wave. So this is an upwards market. It's starting from lower price, heading upwards. It's therefore a bullish trend. And we're making these zigzaggy waves as we go. So how can we talk about these waves? How can we represent these waves? Well, we can do it by looking at A, B, and C. So the A is your first leg, your first wave. So that initial momentum that's going upwards, that's the A leg. The B leg, so as the market starts to come back down slightly, again, there's words for this, more technical words, such as retracement, it's retracing back, it's correcting back a little bit. And of course, if you flip that on its head, that's going to be a small up move. And then you have the next momentum leg, which is the C. So A, up, B, down a bit, C, up even more. Therefore, it's moving upwards overall. So how would you then represent that if the market keeps going? Well, the previous C leg will become the next A, because you're sort of just shifting the pattern up one. And then the next one's going to be a B, because of course the retracement, the correction is a B, and then the next momentum wave is a C again. So A, B, C on the first one. Let's just do that again. So you've got A wave, B retracement, B correction, C, the next impulse, momentum. There's many different words you'll hear, but they all really mean the same thing. C then becomes A. This is like the next wave. So therefore, that's the new A. Of course, we only know that if it does carry on in the same direction. But here we get a B, and then we get the next C momentum leg. So ABC, ABC. And if it keeps going up, down, up, down, up, down, but still moving in an upwards direction, then you just keep going. That top C on the top right there becomes the potential A of the next move. And if you start to retrace, that could be a B, and then a C comes after. So that's how we represent the movement of price action in terms of ABC. I think it makes it a lot easier to understand and represent in your head. So this is a simple, very, very simple way of viewing those waves in the trend. And if you have the ABCs to the upside, such as here, that's bullish. And if you have ABCs to the downside, which we will look at, that would be bearish ABC movement, therefore a bearish trend. So let's have a look at this chart here and identify the ABCs. So there's an upwards movement, there's a downwards movement, and another up, another down, another up, another down, another up. So it's very easy to represent this now instead based on ABC. And you can notice here at the top, right? So you have that big momentum move here. Then you get a move that goes down quite strong, goes up a little bit, and goes down really, really strong. So essentially what you've done here is you've reversed that trend from bullish on the left-hand side to bearish on the right-hand side. And you can then use ABC to represent that also. So if we have a look at the ABCs here, you've got many ABCs on the left, but let's just highlight one of them. So there's an A movement there, which is a continuation. It's a continuation upwards of the bullish trend. There's a B retracement or correction. So it comes down, but it doesn't come down further than the A, otherwise it would invalidate it. And this C movement here is the next momentum leg up. But then what happens? You actually retrace, you correct, you go down further than almost the C, right? So you start to go down very quickly. We can then call this an A because the next move is a small up move, which is a B. And then you get this big movement here, which is a C. So this is an ABC to the upside, a bullish ABC, transitioning into a bearish ABC to the downside. So let's have a think about why does it move like this? What's the mechanics behind this price movement? Why don't markets just go up in a straight line forever or down in a straight line forever? Human psychology basically is the answer to that in simple terms. But here's like an A, there's a B, correction, retracement, and a C, momentum, the next leg. Another B, which therefore there could be a C now. You can, there's a possibility that could happen. And look, there is a C, right? So it's an ABC, ABC, bullish trend. These legs that go up are demand, right? So the terms supply and demand are quite popular in trading. So demand is simply when there's more demand for the asset, right? There's more buying than there is selling. So let's say this is a chart of oil, right? So the oil price. Clearly, during the movements upwards, right, if the price is increasing over time, there's demand for oil, because when the demand goes up, the price goes up because you can charge more for it because more people want it. And therefore, on the other side of that, there's going to be times when supply comes into the market, right? Where there's going to be more supply than there is demand. There's more people trying to sell, and maybe a period of time where less people are trying to buy, or less people interested in buying. So these periods of supply and demand are the periods of momentum and correction. So if you turn this around on its head, you would have the downwards movements larger than the upwards. Therefore, there would be a bigger supply. A bit of demand creeps in every now and again because that's just how the market fluctuates. And then the supply comes back into the market, drives it down for another leg. So clearly here, demand's in control. Overall, the demand is stronger than supply, but this might reverse now. There could be a big, massive move to the downside after this last little arrow there to the right, and therefore supply would come into the market very strongly, demand would drop off, and then at some point the price goes low enough that some people want to buy it, and eventually they sell it back again and the market continues that supply route to the downside. So we have the imbalance of buyers and sellers. If you think about when demand changes to supply, so when you have that move just at the top, or just at the bottom when supply turns to demand, that's like equilibrium, because there's going to be a point where there's exactly the same demand as there is supply, but then the tables will turn slightly to the other direction and it starts to top off, turn around, starts to bottom off and turn back up again. So it's like, you throw a football at the ceiling, it's going to at some point be like perfectly still as the force of the throw sort of equilibrium with the backwards force of the wall or the ceiling. And the same thing, you throw a football at the floor, it goes down, then there's equilibrium between the force of that and the upwards force of the floor, and then it bounces back up again. It's a similar thing like this with supply and demand, which is the equilibrium. So that's the end of chapter 1. Thank you very much for making it this far. You've made it through the whole chapter. And we will then move on to the next chapter, which is chapter 2, looking at styles of technical analysis, so looking a bit more into the tools we can use. And I will see you there.